Hi, everybody. A pleasure to be here. I have been tasked by Andrew to walk you through what we perceive to be the appeal of operational real estate. Now, I imagine many in the room will be either investors in, lenders to, advisors on operational real estate. So most likely I'm preaching to a converted audience. But as we'll see, actually, as we dip into some of the data, it seems like the levels of interest are bubbling up for these sectors. And so there might be some in the room that are here looking with interest, with intrigue. Have I missed the boat? Is there still some legs in these subsectors? So hopefully over the next 20 minutes, I'll either galvanize the views of those of you that are already keen or bring into the fold those that are looking or wavering. Before we get into it too deeply, I think I've been working in the real estate industry for about 20 years now, and the last decade has had a heavy operational real estate focus to it. That started, I'd say, around 10 years ago when I was asked to, or given the opportunity rather, oops, this didn't go. There we go, sorry. Given the opportunity to kind of lead a team. I say a team, it was a team of one, but it did steadily grow in the debt advisory space, focusing on what we termed operating assets. And the reason that, as a firm, we'd taken the view to separate out operating assets, for which we read operational real estate today, was just because the underwriting was so different. It wasn't a case of long lease, TIs, rent freeze, kind of what are my rent steps. Actually, we're dealing with very differing lease durations that could be as short as a one-night occupier duration. How do you acquire those occupiers? What's the risk around replacement of them? What capex is needed to keep assets current, and so on? How do we run the operations? So we took the view that it made sense to cluster all that work into a separate team, thinking around that different modeling approach, and I think it makes sense. It's a little bit harder then, maybe, because there's a bit more work required, but is it worth it? Well, if we look at where the money's going, then I would suggest that people are convinced it is worth it. So looking back 10 years to 2015, at that point, we saw maybe only traditional real estate asset classes for which just read office, retail, and industrial. In this instance, we've clustered residential over into operating. They were soaking up around 2/3 of the investment pounds coming into the UK market. Fast forward to last year, and now that 2/3, over 2/3 has dropped to below a half as operating real estate has started to come more into the fore. Is it too late? Those of you that are maybe looking in and wavering, well, we would say no. If you look across the right-hand side here and compare investment sentiment today versus 21, 22. Actually, we're seeing kind of people that have been surveyed, would you like to invest in student? Would you like to invest in healthcare? Would you like to invest in seniors? All three of those almost or more than doubling in that short 3-year period. So I think in terms of, have we run out of juice? Has the steam come out of the market? Absolutely not. We would see if some of that sentiment translates into deals, there's no reason to think that actually that shift towards operational real estate versus traditional can't continue at a pace. At Green Street, we look a lot at listed real estate as well as private market real estate. And I think that's interesting for today because it's all sense, okay, this is great, but is it the entrepreneurial groups that are looking at operational real estate? Is it the private equity that have the time, that have the energy, have the mental capacity and strength to do that slightly more tricky underwriting to get their heads around the real estate? What about listed markets? Are they still just preferring the easier stuff? Well, I hope you'll excuse me looking at the US rather than Europe. When it comes to REITs, it's just a much richer seam of data to look at. REITs have been around for a lot longer. They have been more specialist, and they still are much more specialist than we have here in Europe in terms of both asset type and geographic location. So it's easier to poke into that and see what we might learn. And what I've shown here, so light green, operational real estate, darker green, traditional. And this is Green Street's research coverage. This isn't necessarily a like-for-like analysis year on year. It's the companies that our research team have chosen to cover, to write about, to send information to our users about. And so to qualify, companies usually have to be large cap, there has to be good liquidity, there has to be a reasonable free float. We need to think that people are interested in investing in them. And so the companies that comprise that coverage universe do change year on year. But what I've got here is we've looked at the combined asset values of the REITs, that of those REITs of our coverage universe in the US. It's around 100 companies. How much of that is in traditional real estate? How much of that is in operational real estate? 15 years back, 70-30 split. 10 years back, 65-35. Now, as you can see, there's been a crossover. And operational real estate is now commanding a far larger piece of the pie for us than it was 10, 15 years ago. For comparison, and I say the European REITs are a little bit, there's a few more baskets that are less specialized, but broadly speaking right now, we're about 65 traditional, 35 operational. So we're about where the US was 10 years ago in terms of our REIT coverage. Hopefully there might be some in here. I think it would be great to see some more REITs come to market in the operational asset classes. We'll see what happens in the next few years. But so that's just the asset weighting. I think this is more enlightening or more illuminating. What I've sought to do here is we've looked at, so again, light green, operational, dark green, traditional. And what you can see here, we've plotted how much time those REITs have spent at or above the share price has been at or above the net asset value. Consistently through the whole period, better performance for operational real estate, so far so good. But more meaningfully, I think, is that box up in the top right, where what you see there is for 52% of the time of those last 15 years, we have seen operational real estate focused REITs trading at or above net asset value, i.e. the public market investors have been happy to pay full price or more to get access to operational real estate. For the same period, less than a quarter of the time for traditional real estate. So REIT investors looking at traditional real estate, they're like, we want a discount to come into that. But overall, there's been a much more interest in that group. So it's not just private equity, it's not just the entrepreneurs or the more kind of interested parts of the real estate world. Actually, it's gone all the way through to the public space. And I think that's very meaningful. Coming into Europe, as I said, less established REIT markets, so maybe a little bit less data for us to work with. So instead, we've just had a look at what's happening on the rent space and looked at a comparison of the rent growth back, 10 years back, 10 and a bit years back. And we see both post-COVID an outperformance again of operational real estate versus traditional sectors. Obviously, we'll all be looking at the various segments that comprise operational real estate, well, in the battle of the brokers to come and later this afternoon. So at this stage, we're clustering. But it's interesting, in a relatively benign environment, still good outperformance by operational real estate. More recently, we've obviously had a high period of inflation, and that's maybe where that lease duration that we talked about as a defining characteristic of operational real estate helps this cohort come into its own with that ability to reprice daily, monthly, annually versus a set of rent growth steps. Enables some of that the outperformance for operational real estate, but that's not the end of the story. If we look to the right-hand side again, this is our 5-year outlook for rent growth. CAGR there, so it's kind of what we expect to be happening year on year. And so more benign inflation environment, hopefully, but certainly forecast as such. And here we see again an outperformance from certain of the sectors within operational real estate looking to do better than traditional. And bear in mind, traditional, yes, there's office in there, maybe not great, Retail, well, actually, we like retail, and we see growth coming through retail. Industrial, again, doing well. So we're not talking about. It's not that the traditional real estate sectors are doing badly, and at 2.4% aggregate, it's, should be a little bit above inflation. What we're seeing is attractive growth available. We expect from operational real estate. It's not just about, I've been comparing traditional and operational. And so within our little real estate bubble, that's not the whole story, obviously. As members of the real estate sector, we are not just competing amongst ourselves for capital, actually we're competing against other investment opportunities. Particularly fixed income is a good kind of testing ground for us. We're not competing against tech stocks, but we need to stack up well against those fixed income alternatives. And so what I've put here is we've compared the returns we would expect to be able to get by various sectors within operational real estate and cluster traditional against bonds. So we've taken average quality assets against triple B bonds as a reasonable proxy. And it looks good, right? Like shaded bars where we were at in January. Obviously, hotel has come in a little bit due to all, so the solid bars are today. That's reflecting some of what's been going on with tariffs and the geopolitical situation. And so hotels, a little bit of a bump in the road. We actually think there's a lot of upside there. This is our average case. I think it's still a lot of Asia Pac, travel to come back. So hopefully that bar starts to move up a little bit. But two key points here. One, compare well against bonds. Two, compare well against traditional again. So, sorry, what? So that is us basically comparing the kind of how much more of a return you would get. So basically it's a 12% uplift, for example. So say it was, I don't know what that'd be. So you expect to get a 10 from a bond, then that would be a 12 from a self-storage, or whatever would equate to a 12% uplift. Does that make sense? But it's risky. Yeah, I think I don't want to maintain a bit of balance in this. So we think there is that return uplift for sure, but we do need to be cognizant of that cash flow volatility risk that is far more pronounced for these asset classes versus others. And by the way, we'll send you the slides afterwards. So keep taking photographs, but we'll make sure you get all these after the conference. So what we've looked to plot here is looking at the cash flow volatility of a sector relative to that lease length. Relatively self-explanatory. Now, what we do have bottom left is, of course, there is the opportunity within this asset class to look at an opco-propco solution. But in essence, by doing so, you're giving away some of that upside by going back to more traditional leasing approach. Also, as we have seen in 10, 15 years back, the risk around operator solvency, operator quality, it may well manifest itself in being left with a problem on your hands as a landlord. And so, maybe the owner-operator approach, and I missed part of the previous panel, but kind of keeping that control, managing the situation yourself, maybe the preferred option. As we think about that, so there is that risk, and I think so flowing that through. Again, jumping back to the US where we have that REIT data, that risk has led to, let's be honest, the last 12 months in the US, actually the REITs that were focused on operational real estate haven't delivered as good a return as we saw in traditional. So it is important to hold everything in appropriate balance. But I would say, firstly, this is the US. This is the last 12 months. So it incorporates all of the craziness of the last few months that we've had since January and certainly since Liberation Day. But more importantly, I think, is to look at the 5, the 10, and the 15-year situation where we see clear outperformance by operational real estate versus traditional. Now, why is that? well, I'd say that the demand supply fundamentals have been very much in the favor of these sectors. Similar characteristics that we see over here, very appealing demographics in terms of an aging population feeding into senior housing, into other healthcare needs, growing participation in tertiary education, growing global student mobility, feeding into student accommodation, growing populations needing to be housed and a lack of sufficient supply coming in. So all of those contributing to this steadily increasing outperformance that we see from the operational real estate segments. And so carrying that through to the UK, and I'll finish here and then let the brokers come in and do battle. Hopefully this won't get in the way of said battle, but I thought what would be useful to finish with is just thinking about what is our outlook, what's our forward prognosis for UK real estate? How do operational classes compare with traditional? And so from left to right, I've set out there what we expect to see. And so it's the premium to treasuries. So what more would you earn by investing in one of these segments versus putting your money into treasury bonds? And that's looking at long-term returns. That's bringing in capex. So that's the full fat cost base in order to do that true comparison. And as you can see, student, self-storage, healthcare, all screening particularly attractively. Residential, kind of coming in a little bit. But if you come back to here, kind of BTR, we've got that at that lower risk point. So having residential slightly into the more traditional cluster doesn't feel out of place because of that lower risk. But yeah, so where are we at? Well, hopefully you all agree with us as Green Street that now is still a very good time to be looking at operational real estate. We think it has lasting appeal, and if we can start to maybe bring some more of that even into the listed market, I think we might start to see some of what we've been seeing in the US manifest here in the UK. Andrew. Hopefully caught up a little bit of time. There you go.